Morning. Today is Thursday, April 28th, 2022. We have a lot to get through today. We'll lead off with the GDP number, GDP for Q1. Of course, it is. We did start Q1 with the Omicron variant, which had a relatively weak consumption, and net exports were expected to be fairly weak in the report. Tom, what are we looking? The expectation was that we'd come in at a 1% growth in the first quarter. That's down from last quarter, which we were up 6.9%. So where did we end up coming in?
The GDP number was negative 1.4%. So a little bit of a contraction here as we get the numbers in. Not ideal. We've also got initial jobless claims that just popped up, and they came in exactly in line. 180K was the estimate. That's where we came in. And then the last reading was revised up by 1,000 from 184 to 185. So nothing burger there, but the big number, negative GDP, not ideal, Ben.
What was the personal consumption number? I think the estimate was 3.5%.
So personal consumption was 2.7 versus 3.5 estimated. So we're definitely seeing the effects of the sentiment around hiking rates, even though we haven't really done it yet.
Did we have what was the GDP deflator? This is the inflation number that's imputed into the GDP number that otherwise reduces gross domestic product.
We're looking at the core PCE quarter to quarter.
Yeah.
And so that was 5.2, which was short of the 5.5 estimate. So everything coming in.
So not only today. Lower inflation, not only lower growth, significantly lower growth on an absolute and relative basis. So that taking a step back, because this is actually fairly important news. We fell from 6.9% growth in Q4 to negative 1.4% growth in Q1. On top of that, you actually had a GDP deflator that came in lower than estimates, 5.2% versus an estimate of 5.5%, as inflation wasn't as big a drag on the number as we thought. And you had personal consumption that was relatively small compared to what we have seen and relative to what we expected. We were expecting 3.5%. We came in a little bit above 2.5%. Question is, does this impact anything that the Fed's doing?
So if you look at the real-time change in the number of estimated hikes for this year, we actually ticked up about 0.1 since this morning, since this number came out. So when we came in this morning, the estimate for the full year number of hikes was 10.6. We're now at 10.71 just after that came out. So it appears that the market is estimating additional hikes for the year. I mean, not even a full one, but something to consider here. I think that the effect of the talk of rate hikes is having more of an effect than the actual hikes themselves. And so my gut would say that we're not going to get that many. If you look at the May meeting, we're at 100% chance of a double hike and a 3.8% chance of an additional hike on top of that. And so my guess is that they probably discussed a triple hike, but my gut would say that given these numbers, they're probably going to stick with 2, since they're already seeing essentially the effects, which is that the economy is slowing, the fire is going down a little bit. The jobs number, I don't really know how to read through on that. It was exactly in line, which always makes me think that that's not a real number. When numbers come in exactly, it doesn't seem like they did much work there. But I mean, what they're wanting to do is happening. They're wanting to slow the economy, and they're wanting to slow it quickly.
I mean, we're now in recession territory. I mean, we have a few more months of this, and we're in a recession. We're not going to be in a recession. We're in a recession now.
Yep.
I mean, what's the thinking on interest rates right now? Where's the 10-year going?
So let me see where we're at. So we've had a bit of a retracement the last week, and I think a lot of that has been as a result of the Fed being in their blackout period. They haven't really been able to say anything. So right now on the 10-year, we're looking at a 283, which is down from last week, but up slightly from where we started this week. We were kind of in the 270, 275 range. We had a really soft 5-year auction yesterday where there's a significant tail on it. So there wasn't a ton of demand at the top of where they were actually offering it. The indirects were very high, which is the foreign. Demand was at, I believe, 64% versus the last 5-year auction, which was only 60. So we're seeing more demand from outside the U.S. than we are seeing from inside the U.S. in terms of who's buying the treasuries. but even right now, I'm seeing red pretty much across the board. And I think people are a little bit worried here and not looking to buy bonds, at least as it looks like the gut reaction here this morning.
Yeah, we may do a blog post on analyzing this GDP report a little bit more. I do think that I presume net exports was a big drag on the number, but clearly consumption coming in lower than expected as well. So not a good GDP number. Again, that's backward looking. We're looking all the way back into January for some of this data. So the Federal Reserve isn't going to be too concerned about that. What they are going to be concerned about is what's going on right now. And right now, jobless claims seem to be in a decent spot. But it just gets to the overall thinking of the Federal Reserve. I mean, we talk a lot about how the Federal Reserve tends to act late. And this is just case in point. I mean, you're actually having the Federal Reserve hike rates, tighten monetary policy into a recession.
I mean, this is an echo of 2018. And I mean, I just feel, I don't know exactly what happened within the Fed in August of last year, but my feeling is that they should have been aggressive then. Rates were ultra low. They could have baked this in, caused a lot less stress on the market. But my assumption is that Jay Powell wanted to stay in his job. And in order to do so, it was in his best interest not to start hiking rates and potentially put cracks in the economy right before he was reaffirmed. And I think that, whether it's ego or just wanting to either thinking he knows what to do and what the right thing is to do, and he just needed 6 months to stay in power in order to do it. But I think that he screwed the pooch here. I think he acted too late, and now we're just like we were in 2018, where things are starting slow, and now we're getting more restrictive on monetary policy, and it's causing some real volatility issues.
I think one of the things to bear in mind here, because I imagine that this will cause alarm bells to ring, including in the media and with the headlines, is that, we just posted a negative GDP number. Okay. The most recent data point in that number was now a month ago. The furthest out data point in that number was 4 months ago on January 1st. So when we're thinking about this, we got to make sure that we're not making decisions based on old news. Because right now the GDP data, it's just reported, but it's old news. So we need to figure out where we're going from here. If we're looking at companies, and I'm kind of putting the cart before the horse here, but we might as well go. It looks like Q2 will be the trough for a lot of companies, including, especially on the e-commerce side. If you're looking at Amazon reports tonight. So we'll look for Q2 to be a bit of a trough in revenue growth there. Facebook is actually up 16% pre-market, essentially because they came out and said that Q2 is going to be the weak point for the year. They've been declining over the last quarter or two. And they say Q2 is basically going to be the bottom on that. Comps will get easier. And some of these headwinds will abate. And we're starting to see some positive demand signals from companies like Qualcomm. Qualcomm's up 5% pre-market, 6% maybe now, because they gave solid guidance. They said that smartphone demand is actually going to be up significantly, and that's on a global basis. Samsung is a big customer of theirs, as well as Apple, so that should alleviate some concerns about Apple, which also reports later today. I do think that we continue to have some headwinds from China. As a result of these China lockdowns. Caterpillar is down a couple percent this morning as a result of some slowing demand there, but demand elsewhere is very strong. So we're starting to see these different regions of the world diversify almost, and not in such a great way in terms of how well their economies are performing. We saw a bit of an advertiser pullback in Europe. In general, North America is actually holding in pretty well. Obviously, this GDP report that kind of throws that a little bit into question, but we're still seeing personal consumption up 2.7%, which is a decent number. I mean, it's not a great number, but it's a decent number for normal time. So, Tom, what are your thoughts about where do we go from here? We just had this bad report for Q1 in terms of GDP, but do you think, are you more in the Fed's camp that we need to continue to tamp down on inflation, tamp down on demand, or do you think because we're actually in a fairly good spot going forward, or would you say, hey, we need to slow down a little bit because I'm worried of where things are going?
Man, I would say I'm right on the line, which is to say, I think in order to rein in inflation, they do need to be tightening monetary policy. Do they need to be doing it to the extent that futures are indicating? I don't think so. I mean, I've always, since the beginning, I've said I think 6 is probably the number. I think that's kind of where we need to be. If we get 2 in the next 2 weeks, then we're looking at 3 for the year. And I think they need to really pause and say, hey, we got this negative GDP number. We need to really consider what we're doing. We really need to consider the effects of what we're doing. And we could definitely be a little bit softer in the landing. But the thing is, they could also come out and say, hey, we're only going to cut, or only going to hike a quarter point, in which case I think the market reacts very positively. The good times will roll. And I think also, just to kind of set the tone, it's obviously not the best thing in the world to hear the GDP numbers, but futures are up. Futures are up big this morning. We've got some really positive news on a couple different companies that's really driving that. And so it's not all doom and gloom. And, the economy is not the market and the market is not the economy. And that's something to always keep in mind, which is that this seems like a very bleak number, but I mean, the NASDAQ futures are up more than the economy contracted. So something to keep in mind as well.
Yeah, I mean, for perspective, GDP decelerated every quarter throughout 2019. It decelerated for the year versus 2018. 2018 was a down year for the market. 2019 was up 30%.
Right.
So that's not to say that's going to happen all the time, but it is to say that the market is not the economy. And oftentimes, I mean, we were still posting recessionary numbers. We were still losing jobs until September or October 2009, or maybe even into 2010. But I know definitely into 2009, we were posting very negative numbers for the economy, and the market bottomed in March of that year.
And I think that so I went to a conference in late 2019. It was a fixed income conference up in Boston. And they were basically saying the writing's on the wall. We're slowing down. We're going to have a very mild recession in 2020. And it's going to be like an early 2000s recession where the average consumer is in a great spot. Corporations are maybe not so much in a good spot. And it's going to be, a couple quarters and we'll rock it back out of it. We'll be right back on track. Obviously, COVID hit. And so I sort of am in the mindset that we've pushed that forward. We had the major 2020 pullback, and that was an anomaly, but we kind of got right back on track where we were. And now we're probably going to have a pretty mild recession. The difference being that corporations are actually in pretty good shape now because the ones that weren't are gone. They've either gone bankrupt or gone away. The ones that are still around got a lot of bailout money. Their coffers are full. They've kicked their debt way down the road for very, very low interest rates. And the average consumer got stimulus checks, didn't spend a lot of money on travel or going out or entertainment. A lot of that money got saved. And so even though the economy is contracting just a little bit, I think everyone's in a pretty good spot. So it's not going to be devastation like 2008. I think it's probably going to be more like, the early 2000s where things were a little tough, kind of post 9/11, but we got right back on track and had a really strong run up until about 2007.
Yeah, we don't have any credit issues right now. Among big companies, we don't have any credit issues. And among consumers, we don't have any credit issues. I mean, American Express is still saying, we never thought we'd get to 2.5% delinquency rate, and they're at less than 1%. So I think we're in a really good spot in terms of credit quality. And I expect that to continue. People have jobs. And if people don't have jobs, it's pretty easy to get a job right now with an unemployment rate of 3% So I think that's a big picture on where we are. I think that we're simply digesting what is the new normal. I mean, you got Teladoc down 40% this morning because they had a huge wave of increased interest in mental health and chronic disease done from a virtual setting. And now that's kind of gone. So you're seeing this digestion of, you do have a new normal, but it's not the extreme new normal that people thought. We're running above trend a little bit on some of the e-commerce that we were of 2019. But it's not everyone's shopping only online, which I think some of these companies like a Teladoc was thinking would happen. And so we're seeing some normalization in that. But overall, and you see sometimes that normalizes a little bit faster than companies like Kroger pick up. And so you see some air pockets. And I think that's what we saw in Q1. Going into Q2, again, I think that you're starting to see inflation come down a bit. I think that you're going to start to see growth pick up in Q3, Q4. You're going to have some really easy comps there as we comp over Delta, et cetera. So overall, I'm optimistic as we go into the second half of the year. I think obviously Q1 is bad, but think about it this way. I mean, it also gives you a lower starting point from which you can grow. So I think that from that standpoint, you can actually spin that positively. And that is backward looking data. Finally, we just want to finish on Japan, because Japan's been in the news. The yen is just getting torched. It's down 15% in the last month and a half. It's down another 2% this morning. Bank of Japan is continuing with its asset purchase program. Meanwhile, the Federal Reserve and even Europe are starting to talk about tightening monetary policy. And Japan is saying that the recent slide in the yen warrants, quote, extreme concern, but they're not doing anything about it just yet. And the question is, does Japan actually want a weaker yen? Because when the yen weakens, it actually makes it easier for them to export. This is why we don't like countries that devalue their currency, because it basically undercuts all American companies. So from that perspective, Japan might like that. Having said that, when a currency devalues 15% in a month, it is destabilizing. It's destabilizing the currency, it's destabilizing the economy, and it's destabilizing the people. Tom, what's your opinion on this and in terms of where Japan is? And do you think that this will have more macroeconomic consequences?
I mean, I think they definitely do want a weaker currency than most. I mean, they're an exporter country. I mean, that's basically when you go into, foreign exchange 101, Japan is what they always bring up. They say Japan is a country that manufactures stuff. They don't have a ton of natural resources, but they do have a very strong business environment. I mean, Samsung and Toyota, Komatsu, you name it, they make it. VCRs, Panasonic, so that's really their game. And so sure, they want to devalue currency. Do they want it to devalue 50% a month? Probably not. But we did get an email a couple of weeks ago from a friend of the firm who had sent some commentary from Jim Grant, who's an all-time market bummer. He writes a very expensive publication called The Interest Rate Observer that we subscribe to. But he was saying that Japan is perhaps one of the next opportunistic areas to be investing in. And that definitely would ring true if they start to really have a tough time with their currency. I mean, basically their entire economy will be on sale. And so looking at things like Toyota or Komatsu or, some of these things that, it's difficult manufacturing right now, supply chain is tight, prices are going up. But if their goods are devaluing versus our goods, then that could be an opportunistic thing where they're going to sell more Toyotas than, maybe Ford. They're going to sell more Komatsu than they're going to sell Caterpillar products. And so, depending on where they're manufactured, also, a lot of these companies manufacture in multiple areas, but the stuff that's being manufactured in Japan is probably going to be basically on sale for the foreseeable future.
Yeah. Thanks, Tom. What is the 10-year at right now?
10-year is at a 286. So we've stepped back 3 basis points.
So I think it's really interesting on a day when we had a bad bummer of a GDP number. We're actually seeing stabilization in interest rates. And by the way, S&P 500 is up 1.25% pre-market. So it's not all bad news. So in fact, the portfolios should be up today.
I mean, Facebook's going to be way up. I think we haven't talked about that yet, but that's something to consider as well.
Yeah. We really just more an emphasis on profit. If you're Facebook, Zuckerberg does this every few quarters. Some quarters he'll get on his soapbox about politics. Other times he'll actually talk about profit and business. And last night was one of the times he talked about profit and business, which tends to be good for the stock. When he talks about politics, not so good for the stock. So with that, we'll leave that there. Again, market up, GDP down, but that's how it goes. So we'll see you tomorrow. It should be another busy day.